actually in San Francisco today. It's an ongoing joke at Zillow. Where in the world is Steve Strong? Because you never know where you're going to find him.
I'm probably the only one that doesn't understand here because I don't know who Steve Strong is.
You might be the lucky one then.
I guess I'm the chosen one.
You and me, Andrea.
And we're live on LinkedIn. I feel like I should say it's live. It's Saturday night, but it's actually only Thursday afternoon. But we are prepared.
Oh, I guess we have to be people.
Okay, it looks like we're live on LinkedIn, and we've got some folks that are starting to join our session. Hey, Michael Vigil, Nadia Gonzalez. Thanks you guys for joining, and looks like we're having some folks join on LinkedIn as well. We'll give it a few more minutes before we start, but I think Bob Schultz has a fabulous joke to entertain everyone before we get started.
I don't know, which one do you want? Well, I heard one. It was actually one of the late night hosts, and I'll change it a little bit. I thought it was kind of clever, and people in credit who negotiate would understand this terrible joke. But there was this deadbeat, and a guy came to collect the money, and he owed him a lot of money. And he said, "Look, I've got a very, very valuable horse, and I'll let you have the horse instead of making you a payment. That would be a win-winny." I told you it was terrible.
Let's go back to the final
about
demand.
the letter at the end, with the letter at the end, the headless guy.
Yeah, that's my only credit joke. There is another credit joke. There's this little boy, and it was his birthday, and he went into his mother and he said, "Mom, I want a bike for my birthday." "Johnny, you've been horrible. You've been horrible. You're not getting it. If you want a bike, you got to talk to God." So he goes into his room, he gets his jacket, and he goes storming out of the house. "Where are you going?" "I'm going to church." And she's thinking, "This is fantastic." And so he's about 10 years old. He goes to the church, he walks in, he sees a statue of Mary. He grabs it, sticks it under his jacket, and he runs home. And he writes this note. He says, "God, got your mom. I want a bike for my birthday."
Oh my gosh.
Yeah.
Okay. Now that we've offended an entire religion.
I know we've offended a lot of people, but it's all in good.
And a profession. Anyway, we're looking forward to an interesting session today. As you can see, everybody is loosened up here on the panel, and we'll be starting the presentation, the webinar, online discussion panel, what have you, in another couple minutes.
Fantastic. And in fact, while we're waiting, it looks like we've got some of the folks from Team Shell Oil have joined us today. So we're very happy to have you guys join us today, and we're thrilled to be working with you all.
When we start, Michelle or Dave, you should explain why I'm here, why they're looking at a guy with a bunch of hair and a beard instead of the fellow that unfortunately wasn't able to make it, so that people aren't horrified what they see. What happened to that guy? Jeez, he looks so young.
We just swapped the heads.
That was a joke I wanted you to tell.
That's an inside joke. So
Sorry, Bob.
I think it's important to point out that when you were in credit, you have to have a personality that you can just kind of like roll with the flow, right? You can't take life so serious because
That is so true.
every day at your job.
Yep.
Yeah, it looks like we've got, hey, Karen Wandrup also just joined us on LinkedIn. So thank you for having us take up some of your afternoon today. Looks like we've got a few more folks coming in too.
And we're at the top of the hour, so I think it says we're ready to begin. So hello, everybody. Welcome to the Credit Captains Conference 2022. This is a 3-day event. This is day 2 of it, where we have over 20 global credit leaders here to help you steer your credit teams through the current economic or the coming economic downturn. My name is Dave Schmidt. I'm a consultant, managing director of A2 Resources, and also a contributing editor to Credit Today, and I'll be your moderator for today's panel discussion. And as with any online event, we have a few housekeeping notes before we need to get started. This will be an interactive panel discussion. If you have a question, please enter it in the Q&A section or the chat box on the right-hand side or the bottom of your screen. These questions will be answered by the end of the presentation. We'll try to get to them during the presentation, but we have a Q&A at the end as well. And all registrants, all participants in this online discussion will receive a copy of the session recording within the next couple days via email. It'll also be posted at hayakoacademy.com. Let me introduce you to Hayako University. And it's the world's first micro-learning and community platform for credit and collections professionals. This platform offers over 2,500 order-to-cash, treasury, and ERP specific videos. Your team can access skill-focused learning paths on financial statement analysis, collections, credit risk mitigation, bankruptcy, and many other career topics. Visit our website, academy.hayako.com, and you can register for free. We have some exciting news also. We've just announced the launching of our Hayako mini certification programs. We've collected over 2,400 online tutorials, over 100 templates, 50 plus blogs, and we've launched the next big thing, skill-based mini certifications to help you train and empower your team and to become the best credit and collection professionals you can be. These are, as a credit leader, you should feel confident about your team's knowledge of credit and collection laws and credit and collection operations. In the evolving climate, it's more important than ever for you to provide your team with a hands-on learning experience, and we're here to help you do that. So please sign up for our mini certification course, which is 100% self-paced, easy to consume, and accessible 24/7. This certification program is designed by Robert Schultz, who's joining us on the panel today. He has over 30 years experience as a global credit and financial executive for multinational companies and is also an expert instructor at the UCLA Extension Service. You can access this certification for $199, but we will be launching a special early bird discount for you by the end of the session. The certification involves a number of components, as you can see here on this slide. We look at the fair debt collection practices, antitrust laws, ECOE laws, Fair Credit Reporting Act, and more. Bob, anything you'd like to add about this?
Yeah, the only thing I would add is we cover these topics because if you're in collections, particularly, and credit, you really need to have an awareness of what these overlaying regulations are, so that you remain in compliance, you don't expose your company to any undue risks. And so what we've done with these tutorials is they cover the basics. They give you enough information so that you kind of understand what they are. We've given you other tools, a checklist, etc. And then we have quizzes, and the quizzes aren't intended to be particularly easy. So it really does require you to go through the material and understand what we're conveying here. And I think it's quite an excellent way of kind of bootstrapping people who are fairly new in the organization, or even people that have been around for a while that haven't had formal training in this. I mean, we're doing these jobs and we know we got to collect at a certain time frame, but we don't understand the context. It's so incredibly important what our companies need to be aware of. So that's what we're intending to do. I think it's good stuff. We'll update it. We have a lot more, even more intrusive type of information that we get from a number of attorneys that we work through that I think you'll find valuable as well. But we like feedback. If there's something in addition to this that you're interested in, or you have any questions or comments about any of these tutorials, we're really open to getting your feedback. Turn it back to you,
Thank you,
Dave.
Bob. When you complete the course, you're going to get a skill badge, so a little mini certificate, and you can add this on, post this on your social media profiles, or just file it away in your personnel file, and take advantage of it in those ways. We've also posted a link so you can learn more about it in the chat box. So you'll see it there if you take a look, and feel free to click on it. So without further ado, let's get going on our discussion panel today. We've got a great panel with us. Andrea Wolf began her career at Weyerhaeuser Company in accounts receivable, has worked her way to become a business AR analyst, and then into the credit department, eventually becoming the credit manager of Northwest Hardwoods division, and then moving up to director of credit, accounts receivable and invoicing. She has over 40 years of experience dealing with AR and credit, and has worked in multiple ERP environments such as SAP, LumberTrack, Get Paid, Great Plains, and CARMS. Kelly Schmidt is an accomplished credit and collections leader with over 20 years of experience. Kelly works for Zillow, a real estate tech company who many of you know. She oversees their credit and collections organization. In her 20 years, Kelly has overseen both domestic and international teams around the world, from Mexico to Poland, India, Singapore, Australia, and more. She's touched most of the continents. She has successfully started many credit and collection teams from the ground up and turned them into top performing, record-breaking teams. We also have with us Michelle Herman. Michelle has over 30 years experience in the credit information, collections, banking, customer service, product development, operations, e-commerce, strategic planning, and business development arena. In other words, she's done just about everything. She brings a highly unique mix of experience, skills, talent, creativity, and dedication, along with an incredible network of high-level professionals across the U.S. and across a variety of industries. She has worked for and with Fortune 100 companies, small mom and pop outfits, and even internet startups. She has created and managed partner programs with major commercial AR software firms such as HighRadius, Amagia, Sephoria, Dynavistic, CMS, Workflow AR, both at Experian and at NACM as a consultant. And last but not least, we have Robert Schultz with us. Bob's filling in for a panelist that looked much younger, was unable to be with us. Bob has, as we mentioned before, a 30-year career as a global credit and financial executive for large multinational companies. He's a founding partner of Quote to Cash Solutions, LLC, which is a consulting firm that covers all aspects of credit and collection processes for companies of all sizes and in a variety of industries. So let's get started. Let's start off by talking about policy changes. So we have a quote here. It's essential for companies to get their credit and collections policies in line with the changing times. So what changes, modifications can we make to our credit and collection policies to best manage credit risk exposure? Andrea, I'm going to start off with you.
Muted. Andrea is muted. There we go.
Thanks, Dave. Sorry about that. First of all, your collection policy for your company is used in audits, is used with the controller of the company, to set guidelines for your company. I think it's important that we look at that as it's
We appear to be having some technical problems with Andrea. So Kelly, let me go to you then.
Base. It's always a moving target. So to me, the key factors here is you use that as a guideline, and then you adjust as you need to based on current economic issues, current industry issues, different things like that. For me, what I would look at is, delegation of authority, pay trends, DSO, percent currents. Those are the key factors, key metric measurements that you look at when trying to adjust with what's happening in your current industry.
And
Kelly,
I actually can play right off of that too. So most of what I heard her saying was, you just want to pay attention to what's happening within the customers as well as what's happening. The reason we're here today is because we're talking about, customers going through a recession. And there's a lot of things that I think companies need to take into consideration when customers are going up and down in recessions. For example, with Zillow, we also have to take into consideration the fact that, the higher interest rates can have an impact on our customers and things like that. So it's important for us from a collection standpoint to take a look at the trends with all of our customers, whether it's our premier agent customers, which are leads that we're sending out to agents versus our rentals.com and various things like that. So we want to make sure that we're paying attention to all the trends she just said, such as DSO, such as, month over month collections, what's happening with our top customers in the industry, those types of things. And then we want to make sure that we have the right people in the right place to be able to manage those things, play off of, who does what well within the company and the organization, so that we can also make sure that we're managing the teams internally well. So.
Yeah, Bob or Michelle, anything to add?
Oh, Bob's on mute.
Damn, I'm on mute. I apologize. I I do have something to add, and kind of tapping onto what has already been said. The first thing is to understand what's going on in the broader economy and what's impacting your particular industry or industries that you serve, because it really depends. It might even depend on the region that you're selling into. So you really kind of have to get as much information as you can as to what is really going on. What are the impacts on your customer base? The other thing is to understand your company. What's their risk? What level of risk are they willing to take to retain revenue? That's another thing to look at. So I would say sit down with your senior executives to understand going forward, what is it that the senior management's looking for? What are their priorities for you to manage to? And then the other thing is, in terms of your credit policy, you may make adjustments. Like I would risk segment my portfolio and try to understand, where do I have to ramp up the requirements for new customers, so that I know, and reviewing existing customers, so that I know I'm really keeping my thumb on the risk, and where do I need to crank up my collections, in terms of the collections volume, and what am I looking for in terms of a policy that I can explain to my salespeople and my customers, so that they understand, what are we doing, where are we headed? So in terms of the credit and collections policies, I think you need to incorporate all of these things and take a look at what you're doing. Maybe what you're doing is perfectly fine, but if interest rates go up, if banking lending is changed, if you have weak customers that are going to be impacted by that, then your credit and collections policy should adjust to that. The other thing is in collections, what are you looking at? You're looking at a portfolio that's 80-20. So you've got the majority of your cash flows from a very small proportion of your customers. So you really need to focus on those, and you need to be able to handle the little ones. You don't have time necessarily if you have a huge portfolio. I think, Kelly does, for example, has a huge portfolio. Then your credit policy needs to reflect the reality of being able to maintain connection with you know, a massive amount of customers. So anyway, that's kind of how I would approach it, and work from there.
Yeah, what I'm hearing from the three of you is that, you know, the first you need to align with the rest of the company. That whole alignment is key and it's strategic. And then from there, you can move then to the tactical. And I think that's what, you know, hopefully we'll be discussing for the rest of this panel is what now then are the different tactics that you can do once you've gotten your policies aligned with the company objectives. Michelle, did you have something to add?
You know, the thought that came to my mind was, you know, about the changing times. My immediate thought was, when you've got a credit collection policy, I would enlist the youngest people on your team, the 20s and 30-year-olds that are out there. They're accessing a bunch of different tools, websites, etc. Have your younger folks see if they can poke holes in your policy and identify weaknesses or other areas where you could enlist a barrage of other tools that maybe we just don't even realize that you could actually incorporate into this to make things rock solid and to make sure that there's not some holes that we're just not aware of because we don't have the time to explore every new alternative website and tool that's out there.
Yeah, that's a great suggestion. Let's go on to the next question. High risk accounts. So, you know, what are the red flags, the early indicators should we look for? Let me try that again. What are the early indicators which we should look for to identify financial distress in a customer? And then once it's apparent that the customer's in distress, you know, what are your next steps? So Kelly, can you start?
Absolutely. So I think some of the early indicators that you want to pay attention to are potential cash flow problems, the customer becoming more difficult to contact, extended payment terms, management issues or high turnover, a drop in sales, downgrades, you know, taking longer to like reply to questions and inquiries and things like that. I think that's essentially what you want to look for from the very beginning. And as far as the second part of that question, I think communication is key, whether it's via phone or email, focusing on the solutions and not so much the problem with the customer, letting them know that we're there to support them and partner with them, but also set expectations with them on what the next steps are if they don't actually pay their invoices. But also we want to make sure that internally we're working collectively with the sales team and our other executives to ensure that we keep them in the loop and also get additional insight from them on what may be going on with these customers, especially if they're an enterprise level type customer.
Bob, what can you add?
I think Kelly really touched on a lot of the high points. So I don't have a lot to add there. The only thing I would say is I've always thought you really need to know your customers. Mm-hmm. So it's very important to have a rapport, particularly with the larger ones, have a rapport with the people internally. If you see that there's changes that you don't understand, try to understand those things as early as you can. I like the comment that she made about utilizing your salespeople or a program manager or a project manager, depending on your industry, to really give you, you know, be the eyes and ears for you and collaborate so that you have some early warning signs. The other thing is if somebody's in trouble, I mean, you have an industry group, you can share order of bureau reports, see how they're paying other industries, not just yours, because they can be a bellwether if they're slowing in other industries that aren't as critical to their operation as your company is. And then you might find the combination of all these things and suddenly you get a big order and they're packing their inventory for the big bang. So I would look for those kinds of things. And once you identify it, you know, high contact, look at alternatives to mitigate your risk, some form of guarantee, whatever it might be. We can go into that in some detail, but there's lots of ways of doing that. Even small companies that have understand the customer of your customer, that's where the money comes from. And there's ways of maybe connecting directly with those customers to mitigate some cash flow risk. So lots of things you can do, but the key thing is know your customers, be involved, get as much information as you can with anyone in your company who has relationships with them. That would be my advice.
Yeah, I think that's solid advice. Andrea, so, are there any other red flags that you could add? And also, what other sources, or what other information sources or external sources do you look at to capture this type of information?
So one thing that I do want to point out is, you may go to work one day and in the morning you find out that one of your accounts is going bankrupt and they've been a good customer, they've been discounting and paying their bills and everything else. So you're not always going to catch everything. We put as many safety nets out there as we can, but you're not always going to catch it, because sometimes even though they're discounting, doesn't mean that they're solvent, doesn't mean that they don't have financial issues. So you have to be aware of those types of situations. The things that I look for are increases in the order file. To me, that tells me if they're coming to us for additional product, they could be on hold with another supplier. Something, might be triggering why they're coming to us. Changes in their pay trend. Always sales involvement. I think the key thing there is to always include your salespeople. They're the ears and eyes and feet on the ground. They can go into an account much quicker than we can. They can drive by a customer and say, hey, there's chains on the gate, or there's trucks being
Right.
or whatever. So I mean, they are your lifeline to collections in my eyes. The industry group involvement is huge, because you can call one of your possibly competitors and just get trade data, factual trade data from them to find out what's going on with them versus what's going on with you. Maybe they have them on a payment plan and we don't. Different things like that. Again, just because they're discounting doesn't mean that there's not a financial risk there. There could be, you just never know. Customer relationship and market trends are key to managing your accounts and potentially, avoiding any kind of financial risk.
Michelle, anything to add?
Yeah, I think we have a tendency to get caught up in, what are the early signs? A lot of the early signs, we look at our own portfolio performance, late payments, things like that. And I think when you talk about early indicators, we should almost have multiple categories, right? So what are our internal departmental red flags from a credit collection standpoint? What are those flags that may come from sales and marketing? Those are critically important, but also what are the external flags, right? So Google alerts, things that are out there. And we were talking yesterday about different economic indicators, industry specific alerts that come from, The Economist. We talked about a couple of those sources yesterday. If you don't understand what's happening in your customer's industry from a macro perspective and your customer's customers, as Bob said, those are things that we can tend to ignore because we're so focused on our portfolio. So I think there's a lot of other ways that if you almost kind of put categories of, internal indicators, external indicators, and, almost just, the gut feel from your staff. I think those are all valuable pieces of input that it's hard to look at everything. But if you can get a sense of and at least know where that information is coming from, then you can figure out how to tame it and capture it and utilize it.
I think Kelly brought up a really good point that I'd like to repeat. And that is, once you've identified, hey, this company's in trouble, maybe I've talked to the bank, maybe they're at limit on their long-term lending. I'm looking at, maybe I've got financials, maybe there's a cash burn. Equity is decreased. They're in trouble. Our job is to create revenue that makes profit for our company. That's what we do. And so if you can work with a customer to help them through it, maybe modify some of your approaches that long-term will work themselves out, then that's the art. I mean, credit is a science and an art. That's the art of credit management. That's frankly, I think, where most of us get our fun. So that should be a main motive. What do you do next once you've identified their high risk? Is, unless the risk is so severe that they're going to go bankrupt next week, what can you do to work with them and maintain some form of revenue stream that makes sense and protect your company in some fashion? You do that when they get out of this mess, you're going to have a customer for life. And salespeople.
And I want to go back to what Michelle said, mentioning yesterday's session, which was on, how do you secure your receivables once you identify a high risk? That's sort of, we spent over an hour and a quarter answering this question. So you might take a look for that session on the Hayako website. It'll be posted there shortly. A lot of good information. But the one thing that Pam Crank said on that session that points out is we spend a lot of time vetting the credit of our new customers. And the fact of the matter is that's not where our problems are going to come from. We need to stay on top of the existing customers. And statistics will bear it up that there's a sizable number of customers that are going to fail, but they're not the people that you just started selling. It's usually people that have been around, which leads into our next question, which is how frequently should you review customer accounts and speak with customers who may be showing signs of risk? And I'm going to go back to our two practitioners and
Dave,
start with you, Andrea.
Wasn't there a question from one of the people?
Yeah, I was gonna bring that up with this one. So Andrea, are you on?
I'm on.
Okay. Yeah, well, since Bob mentioned it, so we have a question. We'll can answer this question at the same time. How frequently should you review customers? And then as part of that review process, Michael asks, when upselling customers, how often should credit collections qualify the customer? So when there's that upselling.
So the way that we went about that is we also manage the order file. So in managing the order file, you could see those upticks and the downticks with those customers. You could see like pay trends, different things like that, that would be an indicator of, hey, we're doing increased volume, this specific term, is assigned to this account. It's not going to manage the volume, so we're going to have to increase the credit limit based on their pay trend, that type of thing. As far as the standard, we tried to review our accounts based on credit exposure limits, credit limits. And we would look at them every 12, 18, 24, and 36 months, depending on the size of the credit limit, whether we got financials, and then actually what was happening with that account in a day-to-day basis, because I could see a specific pay trend for each account. I could see deterioration in how they were paying, if they were discounting, if they were taking under discounts, different things like that. So I think that kind of goes along with your credit policy and procedures. But when you're looking at a industry or a market, trend that's going on right now, as far as like demand, increase in sales, different things like that, then if they're exceeding their credit limits, 50% on a consistent basis, 25, 50%, consistently, then I would look at those accounts and do a credit review. It could be a quick credit review. It could be just soliciting some trade references, possibly a credit report, pulling things like that. I think a lot of that, for me, was driven based on managing the order file.
Okay, and Kelly.
From a Zillow perspective, and even previous jobs that I've worked with, it's, we're looking at our aging reports consistently on a daily basis, looking for those trends. And our top customers that are really driving our revenue, it just depends on, are we talking to a decision maker, or are we talking to somebody that has to go to a decision maker? If we're talking to the decision maker, we may reach out to them once, twice, maybe 3 times a month to be able to get to where we need to with them. If we have to figure out a roadmap to get to the decision maker, we may contact the account multiple times to get what we need out of them. I think that there's a lot of things that really go into how we work our accounts and, the different amounts of time that we're actually going to contact them. Is that me?
I think so.
Fortunately.
Okay. Sorry about that, guys. Lost my train of thought on top of it, but ultimately at the end of the day, it really comes down to who are we talking to, and as far as the amount of times we're going to contact them, what's the situation with the customer? I mean, is it a cash flow problem? Is it an administrative process problem? Is it an invoice issue, account setup? We have to figure out what the root cause, and that's ultimately going to determine how many times we're contacting them too.
Yeah, Bob, Michael asked a corollary question and throws a little consultant speak at us. What are the risks of using CHIP, challenge, impact, influence, priority versus BANT, budget, authority, need, and timeline?
I haven't got the slightest idea. Be quite
Not
honest
familiar
with
with those.
I'm just a poll boy, I just kind of muscle through it. I'm not quite sure how to respond to that, to be quite honest with you. Does anybody else have any experience that would relate to this question? Let me answer another question. And it relates to Michael's first question. Two things. First, I'm sorry, Michael, for distracting from, which is a very legitimate question and I'm not quite sure how to answer, but the other thing you asked, I think, is incredibly relevant. First of all, the frequency of a review, let's geek out here. You have a credit policy. We talked about it a few minutes ago. I think that if you categorize your portfolio in terms of risk categories, and you assign a review cycle based on those risk categories, then you have some structure and some consistency to how often you touch your customers. And there's always exceptions, when there's some major turn of events, then obviously you're going to do a review. But when you have a whole portfolio, I mean, one way of managing it is to have some structure in your policies, how often you touch them. In terms of upselling, in my experience, I've dealt with all kinds of different companies. And one company comes to mind, they had a distribution channel. It just seemed like at the end of every quarter, they were upselling a lot because there was a commission involved in the sales rep and they were packing the inventory. So the first thing I would ask is, why do they want all this stuff? What is the need? Explain to me why I need to go above and beyond the credit line I've already approved, and try to understand that from a business person's standpoint. Who is the customer's customer? Why do they need it? Does it make sense? What's the cash flow that'll come from that? And then you make some sort of a decision. But I would start with asking, okay, what's the rationale for the upsell? And what can I do to make it happen if it makes sense?
Hey, Bob, this is Andrea. Can I jump in?
Yeah,
Please.
Go ahead. Okay, Andrea,
So
you're coming across garbled. So maybe if you stop your video.
Coming from the wood products industry. Okay, is this better? So just to jump in and kind of talk about some of those upselling. Currently in the wood products industry, the price of lumber has just doubled and tripled in some of the products. And so all of the credit limits that had been established for our existing accounts, that we've had some of those accounts dating all the way back to the 1950s. Those credit limits have been increased and managed and reviewed and everything else. But with the price increase of lumber, we were upselling those accounts because we were selling the same volume, but the price of the product had grown so much that the credit limits were double or 25% more, whatever. And so you're always going to have those types of situations. And whether, I don't know, whether you're in fuel or wood products or apparel or luggage, whatever, there's those exceptional type situations that are always going to come up, and that you have to figure out, okay, is this an ongoing upsell? Is this going to be always, are we always going to be over the credit limit, or is this a temporary ride? How long do we do it? Is it 90 days? Is it 6 months? That type of thing. So it depends on the situation as to, you know, do I go through and do a full credit review and try to increase this credit line, or is this just kind of riding the wave of the price increase and it's going to be down in 90 days and we can go on our merry way? So those are just things that I experienced in my credit world. And, you know, that whole increase in the price of lumber impacted all of our credit limits that we had established. And I mean, we were constantly, with the help of managing the order file, trying to look at those credit limits and say, is this one that I need to increase, or is this one I need to ride the wave, or is this one that I need to, I'm going to pull them back and be within the credit limit. It's managing the categories, you know, because all of your customers are in different buckets. We deal with Amish accounts all the way up to the Forest Rivers of the MHRV world, you know. So, I mean, we had a huge spectrum there of different types of customers.
Yeah, and that's a situation that doesn't just come from price increases. I faced it when I was managing credit, when the company came out with a new product line. And, you know, all of a sudden you're selling, you know, this one product line, and then we have another product line that could potentially double, you know, what everybody was purchasing from you. So, yeah, as Andrea said, you know, you've got to categorize it, you've got to segment it, you got to look at where the risks are versus where there's plenty of capacity, and move forward from there. And you need to share that capacity information, I think, with sales is extremely important, because who do we have that we can sell more to easily, is usually important to bring out.
I used
Anybody
to send
else?
sales executives a letter periodically saying, here are the customers that you're responsible for. Here is their credit line. Here is their outstanding balance, which is a lot less than the credit line. Why don't you go out and sell more? Used to really make them angry, but it was a good point. And it also turns the table in terms of the negativity about the credit department. But I just got to say one more thing here. As credit professionals, we have an obligation to our customers too. And we want to make sure, particularly in times when it might get kind of rough and commissions on sales may be going down and sales reps scramble in those situations. And you want to make sure that they're not overselling to a weak customer and putting them over the edge. I've seen that happen. And I've seen companies go bankrupt because they were oversold and they didn't have the, you know, cash conversion cycle to support the inventory they were taking on. So as credit professionals, I think it's really important for us to know our customers well enough to protect them from that and be an advocate for our customer too.
And on top of that, your salespeople are going to go head to head with you on that. But you're absolutely right. It's our job to protect our customer base as well.
Well, it protects your company in the long term.
Correct.
That's for sure.
Yeah, Michael gave us a little bit of explanation to his question, in that, you know, one, it relates to organic growth, relating to new customers who may not be bona fide if using CHIP, you know, going with the challenge issue for the sake of growth, versus to the dollar net retention, which is, we've just discussed, selling more to the existing customer set, though they may not be able to afford the new products. So, you know, the issue, you know, as I see it here is, you know, it's going to be resolved really the same way, whether it's a new customer and you're trying to support their growth, or it's an existing customer and you're trying to sell more product to them. You're still going to be making the same type of credit decisions with them, but it comes back to knowing your customer and working with the sales department and finding different means of helping to sell them. And I think we get into that on the next question. So I'm going to move it along. And so financial distress can quickly can quickly escalate during times of economic stress. So how do we mitigate risk? And here we go with one is undercapitalized small business. And we might also add in there over leveraged large businesses. And what are the steps to take to protect against downside risk while preserving upside revenue opportunities? Bob, do you want to start off on this one?
This is one of my favorite topics because this is fun stuff. It really is. And there's so many tools that we can use that aren't really commonly used. No, I mean, you can get a personal guarantee. In my view, that's more of a psychological instrument than a reality. You can, with a smaller company, they all have blanket liens from their banks. What I did many, many times is I would go to the bank. I would say, look, I'm a primary supplier. I keep their cash flow going. I help them pay your loan every month. What I want is I want a blanket lien just like yours. I'll subordinate my position to yours. And then depending on your industry and your product, you get a purchase money security on anything you ship. And the one thing that does, it puts you ahead of other creditors, gives you some assurances that if everything goes south, you may be able to retrieve something. At least you, if it's possible, you can grab some inventory back if it comes to that. Other things that I've done is escrow agreements. Sounds very exotic. You do an escrow agreement. You can do other kinds of payment mechanisms where the customer of the small business may be selling to a huge company. So you can actually organize direct payments from that company. There's various ways of doing it. We can go into it in detail, but there's various ways of doing it so that you're getting payment directly from a reliable source, but the undercapitalized small business is being paid their profit and you're being paid your invoice values. So I think there's all kinds of things, letters of credit, standby letters of credit. There's all kinds of things. The important thing for a credit manager is to understand we're going into troubled times and you need to have a lot of arrows in your quiver right now and be a hero to sales because I have options. I can do these forms of guarantee. I can do different forms of payment mechanisms. And it varies. Again, it varies by industry, but I did this a lot for many, many years and we're able to sustain ourselves, not have bad debts and actually grow business among these types of companies. So anyway, that would be my approach. There's a variety of tools on the shelf. When the need arises, I pull out the best option and go for it.
Kelly, what can you add?
I think we might have lost Kelly.
The other thing is where we're waiting for Kelly, because I can go on like the ever ready bunny. As we're waiting for Kelly, the other thing is to really understand your customer's financing because they're undercapitalized. But what does that mean in terms of their bank lines? How close are they to the bank lines? Are there any things that will trigger the bank pulling the loan? Understanding, are they paying for long-term assets with short-term borrowing? All these things you kind of try to understand. And the other thing is, if you're trying to do a risk assessment, if you can get to the bank and you say, what's your lending formula? The bank's done all the work for you. I mean, they've seen the books. They are calibrating their lending formula, which is based on my operating costs, my desired profit, and the cost of my funds, and the variable is risk. So if they have a really conservative lending formula from the bank, that tells you the bank is concerned, and that can help guide you as to what the level of risk is. With the bank, you may not get financials. There may be 3 sets of financials in a small business. The one for the IRS, the one for the wife, the one for the whatever. But the bank knows. So that's another trick. All right.
Is Kelly back with us? Or Andrea, do you have anything? I'm sure you have some things you can add in.
So I went through an experience with a company that had been in business for over 100 years. They became financially distressed. They called all the key suppliers, I think it was the top 60 suppliers, to a meeting. And they had brought in a company where they were trying to financially restructure the company. And they were working with the bank. And and the bank came back and said, well, we need to understand where the vendors stand. And so I was a vendor, I was a supplier. So I was at this meeting, and they wanted us, to sign off on extended terms and extended credit limits and blah, blah, blah. There's door suppliers, there's large door suppliers, there's lumber companies, all kinds of people in on this meeting. And my question to the restructuring company was, where is the bank on this? Well, the bank is waiting to determine where the vendors are. So right there, that's your key indicator. And I told them, I said, I'm sorry, but I can't commit to anything for my company when I don't understand where the bank is. So that kind of supports where Bob was going with, the bank does all the work for you. So they knew exactly where this company was. But I mean, those are the steps where you have to go, okay, I need to stop, adjust, look at where the bank is, look at where my exposure is, look at where my risk is, look at where the company is, and where we go from here. And, you may pull the credit limit, you may change the terms, you may shut them down, you may choose to continue to sell to them. But I mean, it's very, very important that you understand where that bank is in that entire relationship, because those can be indicators as to whether you're going to pull in or go with the flow.
Yeah,
Banks are draconian. Banks are draconian. If they see the asset base diminishing relative to their loan value, they're going to pull the plug. Period.
Yes.
They don't care what the vendor, what impact it has on the company or the vendors. They're very
Right.
draconian.
This was back in 2008 and 2009 when the housing market was having a major problem, and lots of your banks, Wells Fargo, Bank of America, all of these high-powered banks were looking at all of the loans. And especially like for me in the wood products industry, that was a huge thing because it went along with the housing market. So those are all things that you have to be, aware of, pay attention to, look for the articles, look for the news, listen to what's happening out there in that market, because that will be your indicator as to how you're going to shift in your credit policy, in your customer management, in your risk analysis, all of that.
I had a similar situation, and it was in the office products industry, and this company called all the creditors in. And after they made their presentation to us, we sent them out of the room and we started talking about it, and everything just didn't add up. And so we decided to form a creditors committee right then and there, banded together and put them in bankruptcy. And the bankruptcy trustee, consequently, we worked obviously closely with the bankruptcy trustee through this whole thing, ended up filing a suit against the owners of the business for fraud. And they had been taking equipment and other things and moving it to a shell corporation and stuff like that. So there was a fraud involved. And when things don't add up, there's a reason for it. And actually the owners went to jail, and all the other company was put into bankruptcy, and all the assets from that helped pay off some of ours, but we didn't get much.
Right. It's really funny because when credit's good, it's good, and most of your day is a normal day and you just go about your business. But you also have those one-offs. I had a case where I was on a creditors committee, and we filed a suit against the auditing firm because they had done a recent audit, and we found $6 million worth of inventory that was actually firewood. Just different things like that. We went after the owner, we went after the auditing firm, we went after several sources to get money back. But again, the bankruptcy was so big that it was a drop in the bucket, but it was fun. Energizing.
You learn a lot from those situations.
Those are your best learning experiences, because you're just going, oh my gosh, I'm so overwhelmed. You know, it's just coming at you handful, tenfold, you know, you can't take it in fast enough.
I had a guy
Yeah,
one
but short
time,
of that,
he owed
hopefully-
the bank a lot of money, and he faked the divorce, put all of his assets in the name of his wife. They're still living in the house. But I mean, you know, you see all these weird things, but I think the bottom line here on this slide is what we really ought to focus on. Understanding, you know, all these horrible things that could happen. There are things we can do to really keep it out of the fire and keep product moving out of our company. I think that's really where we ought to focus in credit, but not naively. And that's the point of these stories. No, don't be naive and really understand what's going on. And that's the other thing. Now we can do customer visits again. To me, that's one of the most valuable tools a credit manager has. Doing a sniff test, going on site, looking at the property. Is it busy? Is it not busy? Is it organized, disorganized? Is it clean? Is it dirty? What do the people look like? Are they professional, or is there anybody there? And then you start asking a lot of questions about the operations. Take a tour around the warehouse. I did a financial review with a distributor one time, and the financials looked okay. And then I said, "Can I take a tour of the warehouse?" And when I did, I started looking at racks full of dusty boxes of product and rows and rows of broken returns. Is that the inventory that you're claiming on your financials? And a very red-faced owner of a company said, yeah. And I knew that it was, because I was there, I knew that this was a problem. So customer visits to me are a tremendous tool in protecting. And then when you talk to them and you understand what their business is and you understand who they're selling to, then that might give you more information you need to actually expand their credit line. So
Right.
Anyway,
it's important to look at their inventory, because then you know who else is selling them. You know, you can walk through a warehouse and you can see units of lumber, or you can see whatever, you know, you're looking for, what product it is, but you can see who's selling to them. You can see the amount of dust on those units, you know, different things like that, how fast they're moving, different, just those are your key things to pick up on when you're doing a customer visit.
Yeah.
Great. And Kelly is back with us. Had some technical problems and dropped off.
Yay
Kelly,
for
anything? Yeah. What can you tell us about the steps you take to, help secure or help mitigate the risk with businesses that are in distress in your portfolio?
I think a lot of it just comes down to, like, specifically what, my focus in my career has been on. It comes down to all the same things that I've reiterated earlier in the call. You have to look for all of the issues that the company is currently having, and you have to take a look at your inventory, as far as, the overall risk with these small businesses and how to protect yourselves and things like that. It's again, the right people in the right place. It's paying attention to those aging reports. It's making sure that we're doing the proper follow-up. It's, doing everything that a collection team should be doing to get themselves into a position to be able to work with those customers and protect those customers, and also protect the companies that we work for too. So.
Okay, great. Let's move on. Next question is international customers. And so, what are the parameters that you need to keep in mind while setting up credit boundaries for an international customer? What do you do different in that regard? Andrea, I'm going to go back to you.
So we did work internationally. We worked both Europe and the Pacific Rim, Mexico, China. We did a lot of our credit terms. We did cash against documents through the bank. We did cash against documents where we held the documents in our office. We did cash in advance. We did telegraphic transfer. We did non-refundable down payments. So if they were doing a telegraphic transfer, then we would require 50, 30, 40, 50% upfront. And those were non-refundable, so that if they did cancel the orders, that we had some way of diverting that load as it was on the water going over to China, Taiwan, that type of thing. There are risk or guarantee type transactions that you can do. For my particular business, we chose to do the cash against documents primarily. Now that does impact our cash flow because we did not get to use that in our borrowing base. So there's things that you have to think about. Yeah, we can sell cash against documents, but if you do an ABL, an asset borrowing lending transaction with your bank, you don't necessarily get to use those dollars in your funding, so that you have to manage how much of that you do, so that it's a balancing act of making sure that what you can borrow against versus what you can't borrow. I can tell you, in all of my years of working with the Northwest Hardwoods business, which was 22 plus years, we had no bad debt internationally.
That's terrific. Yeah, I guess just to probe a little bit further. So obviously different markets require different terms or policies. And so obviously third world economies are going to treat different than European. And obviously emerging companies are going to be treated different than established companies. Information I always found was difficult sometimes in terms of the know your customer side of the equation. Anybody want to comment on that further?
I think for my specific industry, like some of the things that we have to do a little more due diligence with the type of customers that we work with. It's like we need to make sure that we fully understand all the local laws and regulations, the contracts, the various currencies. Are we going to actually, bill in their currency versus our currency in US dollars? Are we going to process credit checks on these guys? And if we do, it's like, how does their scoring differ from customers in the United States? Will they be put on credit card terms or net terms based off of all of that? It's, those are the types of things that we have to look for, and the parameters we have to put in place for the type of work that we do. So that's just something that Zillow and previous companies have done as far as credit checks and those types of things for international customers.
Bob, I know you've done some international.
Oh, yeah. And I've used all the tools that Andrea described so well. So we don't need to go back into that. There's all kinds of tools you can use. But the other thing, and people that are listening, maybe you're new to international credit, there's a tendency to think that, companies in other countries can't be trusted, or they're not up to snuff with American businesses or whatever. And when you travel the world, you find most of the time the opposite is true. These are legitimate operations with quality people running them. And so knowing your customer is very important. Having a local representative that can help you with that is important. Travel is important if you can do that. But I would say, number one, get to know your treasurer very well for if there's issues with money exchange, and get to know your international banker very well. A trusted international banker can give you all kinds of insights and help and when you're kind of wend through this, particularly if you're new to it. That would be my advice.
Okay,
this is
go
Andrea.
ahead.
Just a little bit of information here. I think it's really, really important that you use your sales team as well. We would do, OFAC checking and different things like that. But lots of times these accounts are out there for 3 to 5 years, like in China, and then they close down and they reopen under another name, and then they, reopen under another name. And I've got several accounts that I could refer to, but I'm not going to. So it's knowing and trusting your sales team, because they're the ones that do have the feet on the ground there. Obviously, I didn't travel to China a lot, or Taiwan, or any of those, Indonesia, that type of thing. So I depended on them drastically to be my eyes and ears.
The other thing I would say is watch out if your company is using agents, particularly as it relates, you got to have a solid understanding of compliance, and you have to know who you're dealing with who's an agent. I had trouble with an agent in the Middle East where it was involved bribery. It was just horrible, and our company was going to take a significant loss. I worked through the State Department, and they went after this guy, and we got paid big time because he didn't want to be shut down by the American business. So that's another thing. Understand, if you're working through agents, who they are, understand the compliance regulations, and understand the country risks.
Let's move on. And related to international, as we get into trade credit insurance, something we haven't mentioned in that regard, and it's very often used on international accounts, but can also be used for domestic. Any thoughts or comments from any of you on this?
I myself did not use trade credit insurance. The cost of the insurance it didn't make sense with our bad debt. We didn't have bad debt, so it wasn't really anything that we could pursue just because it didn't make sense for the company. Now there is the XM Bank, which you can do in individual accounts, individual transactions, which again, there's a cost to it. Understanding the cost and making sure that you recover that in your margins and things like that, or consider it in your margins. There are times where it makes sense. I did a lot with Mexico. When you deal with Mexico sales, you understand that you're going into it with 60-day terms minimum, and if you get paid 90, you're happy.
I've advised clients.
I know
I'm not a fan. I'm not a big fan for reasons that were just mentioned, but I have had clients that have used it quite extensively. And the only thing I would warn you is when you're using a credit insurance company to do your credit evaluations and set your credit lines, you basically have outsourced those functions, and you've limited your company's opportunity. You can always go above and beyond their parameters and self-insure in essence, but that always worried me. And there are so many varieties of offerings these days. It's a matter of cost and benefit. You have to evaluate that. But the one thing I would say, I've been an expert witness on both sides of suits with trade credit insurance companies. If you're going into this world, remain in compliance with their parameters. Don't go outside, because they will just absolutely use everything in their power to not pay you. So make sure you're in compliance with their formulas, their deadlines. Very, very important.
So it's like any other type of insurance in that regard.
Well, and understand if you're going to have to eat product back a year later. That's the other thing. Make sure you understand the terms of your agreement with is there a recourse? Make sure you understand what the reality of your agreement with that insurance company is.
I had a good friend who used credit insurance. He was actually up in Canada and sold a lot into Europe, but also in Canada. And he had several instances where he did his due diligence and did it better than the credit insurance company. In one situation, he was able to get credit insurance on a large chain within Canada, and credit insurance company granted it. The thing is, he had noticed that there was some issues with the parent company over in the Netherlands, and ultimately the parent went bankrupt, and so did the Canadian chain. And because he knew what he was doing and had dotted all the I's and crossed all the T's, He got paid a lot of money from the credit insurance company, and they actually brought him in to help teach their analysts what he was doing. So it can be used. It's used extensively in Europe, and as Bob mentioned, if you're going to use it, it's really sort of an outsourcing situation as much as being partially insurance, because you're going to rely on their staff for a lot of the credit decisioning, and then you're going to have to incorporate that into your own policies. Anybody have anything else to say? If not, we'll move along. So in terms of customer relationships, and we've talked about that a lot today. So, managing credit risk is a key priority in today's dynamic economy, but we've got to manage that within the bound of the customer relationship. So how do you strike a balance between the ongoing relationship, payment risk, your company's revenues, and cash flow objectives? Kelly, would you like to start?
Oh, I think we lost Kelly again.
We lost Kelly again, which is unfortunate. Andrea, Bob, Michelle, chime in.
Bob, I'll let you go first.
Me? Oh, well, getting back to, I think, the very first slide, you have to understand what your company's risk tolerance is, their revenue, their cash flow objectives. You have to understand that. And I think a lot of credit people, they're kind of isolated from that. And that's something you really need to understand, because that's going to characterize how you behave. If you're marching in a different direction, it's probably marching out the door eventually. So I would really be aware of how my department's metrics and so on fit into the overall overarching company objectives. And I think that, it gets back, it's very simple. I mean, know your customer, have a relationship with your salespeople, and really demonstrate the fact that you're trying to generate profitable revenue for your company, and communicating. I teach these classes at UCLA, and one of my favorite things is I give them discussion topics every week. Maybe some of the students are listening, I don't know. And I say, hey, you're sitting in your office and a red-faced sales executive comes in because he or she is very angry about your credit decision. What do you do? And a lot of the reactions are, I go tell them to pound sand. I mean, that's not an answer. That's not an answer. You use, and I repeated this in tutorials and other podcasts we've done, but it's so basic. The first thing you do is you say, why? Why is this necessary? And how can I work with you and and the customer to make this happen? Sometimes it doesn't. And I like the other thing, and I've talked about this before, is I had a situation where the sales guy wanted me to go out and see a distributor we had turned down. We said cash only. And to be a good citizen, I went out to this distributor's location to find an empty parking lot, a very expensive facility, extremely expensive walnut paneling. The whole place was empty except for 2 or 3 people, no phones ringing, nothing. I went into the conference room. There was an older man who was the owner of the company, who came out of retirement because it was going downhill. And there was a turnaround guy, and we went through the financials and everything. As we walked back to the car, I mean, the sales guys are so impressed by the building. I mean, first of all, I said, hey, we're over distributed. Why do we need another distributor in this area anyway? That's the first thing. Secondly, this guy's going down. They're going to be shutting down within a week and a half. I'm looking at their financials. It's going to happen. So several days later, true story, I get a call from the same sales executive, and he says, Bob, you're a saint. I said, hey, tell my wife and my kids, for crying out. Yeah, okay, what happened? So the marshal came today and put chains on locks on the door of that company. And the reason I bring this story up is that it's not always going to be a positive result, but if you demonstrate the sales, you're doing your best, and you give them good advice, and they see that sometimes they're going to lose their commission. They're not going to have upsell opportunity. They're going to have anything. And they need to listen to credit because you have some insights that are very valuable to them going forward. So I would advise, that's another outcome of this, possibility of working with customers. Not always going to be, flowers and good wine. Sometimes it's going to be negative, but that's not necessarily a bad thing for the next decision that has to be made. You guys agree with me? I don't know. You're long in tooth in this, Andrea. I don't know if Kelly is back. What do you think?
Actually, Bob, I had a very similar situation. In fact, they kept trying to sell this one account, and I'm like, no, this is not adding up. There's something there. They wouldn't provide financials, blah, blah, blah. But anyway, years later, I kept a pretty tight rein on this particular account. We would get past due. We would go to the credit limit. I was trying to be as lenient as I could because I wanted to show the salespeople that I was teaming with them, the sales team, that I was teaming with them. I was teaming with the customer. I'm working together. We're all in this as a team to make this work because we need customers to make our business go round, right? I mean, we have to have somebody to move our product to, et cetera, et cetera. Anyway, 3 months ago, I got a phone call from the salesperson who has since left the company. And he said, Andrea, I just wanted to call and tell you, you were right. And I'm like, what are you talking about, Josh? He goes, you were right. They went under. And I'm like,
hallelujah. Praise the Lord. Oh God. Well, the other aspect of this, and maybe it feeds into the question pretty well, is you have a credit policy. You may determine based on your credit policy that this can't happen. I can't authorize that. I have some flexibility, but I can't authorize that. But you know what? I think it's a good business decision. I've looked at the facts. I think it's a good business decision. So what you do is you have an escalation policy to get other eyes to look at that, depending on the dollar exposure. Could go all the way up. I had a policy at one company I worked with. One thing in 11 years went to the CEO, and I agreed with it. I thought it was a good decision, and the CEO had to authorize it. So if you have some flexibility to make business decisions, which could be quite different than a credit decision, and have quick, facile escalation policies, then that helps. I mean, it shows that it's a team effort.
There's another way to handle that too, Bob. I've seen companies do this, is they set up a segment of the portfolio and they put a cap on it, say $1 million. And that's for any of these customers that you wouldn't normally give credit to, but sales has convinced management that it's a good business decision. And so you sell until you reach that credit limit. And then no more sales of that type. You cap off your risk and contain it. And the companies that have done this have generally, there are more bad debt losses doing that. But the thing is, when you look at everybody together, and as a addition to the portfolio, it had the extra manufacturing capacity and all that. It was profitable business. You were still making profits. And I think that's what a lot of credit collection comes down to. It's your job is to help the company make a profitable sale.
Well, understand what the profit is. If it's a really high profit, more risk. It's low profit, less risk. I also had fun with salespeople that came up with really dumb proposals. I would say, we're going to do this. Oh, this is pretty fun. We're going to do this, but we're going to set up 100% reserve against it. And that really gets them because they can't, there's no revenue. I mean, you're putting a reserve against whatever you're selling to them. And that, that's another thing you can do. And if it's really something you don't want to engage with, set up a reserve, see how it goes. Or you'll say, the salesperson will come and they'll say, well, I need a $500,000 line of credit. Why? They'll tell you why. Well, what do they need in the next 3 months? $150,000. Okay, well, we're going to set the credit line based on the terms and what their actual take rate is. I'm going to set a credit line that says, you know what? If they pay me within 45 days, good. If they go over 45 days, we're going to talk about it. And you kind of balance your exposure with the terms. I'm shipping at this rate. I've got this kind of terms, and you can kind of balance it that way and kind of keep tight tabs on your exposure. And then you build it up, because the salespeople may be way over exaggerating what's actually needed. And you can set up a credit line that makes more sense, and then build it up over time. And then you're more comfortable because they've made payments and you know them and everything's going along. So there's different ways of working those kinds of deals as well.
Yeah, and you need to understand it within the context, into your own risk context within your portfolio. Where is risk concentrated in your portfolio? What are the dollars at risk? Among all your high risk accounts, are they large customers? Are they small customers? What's the dollar and the percentage compared to the whole portfolio? And that helps you make better decisions and understand how much you can open things up or tighten things up. And I think, as Andrea's mentioned previously, deal with the different segments differently, which you need to do. So let's move on to got just one more question here, I believe. And, we've talked about sales here on this last question. So any other things that we can do to help initiate the two-way communication, help them to help sales to be our eyes and ears? Anything that we can do to build teamwork here?
Yeah, I'll jump in here. It looks like we've lost both Kelly and Andrea. So I guess this is kind of my favorite question on this whole session. I actually spent a lot of years in sales, but before I ever got into sales, I actually worked in credit and banking. So everything I did in sales always was slanted by that view of, are we making any money? How do you make sure this deal is paid? And I think that if you've never been in sales, you have this fear of, what are salespeople going to think? How are they going to act? You only kind of see what you see. But if you can understand what the sales rep is trying to do, is really the sales rep they want to sell the product because they want the company to be successful. Sure, they want to make commission, but they also want that company to be successful. And I worked at rent.com for many years, and it was kind of to one of the prior questions. They had specifically hired me about a year before they were either going to do an IPO or be acquired by someone. They were actively engaged in this process, and their collection department was a mess. And they literally wanted someone to come in who had really some empathy for salespeople, and who was not a hardcore collector, but was someone who understood how important collecting the bills actually was. So it was kind of a weird position. And the whole approach was, they were very concerned because of this impending IPO or acquisition, that they had a lot of past due accounts, basically because the department had been a wreck, but they didn't want to alienate any customer. They didn't want any bad news. They didn't want anyone, customer, good, bad, ugly, to have anything negative to say about them in the marketplace and in the industry, because that pending IPO or acquisition, that was the most important thing. And so we did a whole bunch of things to make sure that we could collect as much as we possibly could without going too far and alienating people. And then after that IPO, we actually were acquired by eBay. And as we went forward in that, what we did to make sure that we were on the same page with the sales team is we met with them regularly. I made sure one of the first things I did is I met with the VP of sales. I met with every single sales rep, and we talked specifically about, what are they trying to do? What is the company trying to achieve? What is their role in that? And what we ended up creating, we were actually all using Salesforce.com, the sales reps were. And so we got a license to that. And so we started creating a set of dashboards and modules about what's happening in credit and what's happening in customer service. So we ultimately ended up creating a stoplight system, right? So red, yellow, green. So every time our sales reps would log on to Salesforce.com, it was right on their homepage, how many accounts of theirs were red, yellow, and green. Red ones meaning, don't even go try to sell them more business. Don't try to upsell them, because they're on the bad list right now for us. We don't want any more business from these people because they're already not paying us. The green lights, go after those green lights. Hey, these are people that their credit is good with us. Their credit is good overall. We had a scoring system in place. sell more to these people. And that was every single day a way for them to make a choice. Do I want to go after selling people who were kind of on the shit list? Or do I want to go after the green light ones? I want to go after the ones that I can get them to sign up. I can offer them a deal that they're already pre-approved. And the yellow ones, if you really had a deal with whatever management company and you really wanted to sell them, you had some interest, but they were kind of like the problem, you could click on that account and it would in detail tell you, why are they in the yellow zone? And you as a sales rep, if you were savvy enough and you wanted to do it, you could say, listen, I'd like to put you on our advertising program for XYZ. You're going to get way more leads. You're going to fill up your property, but we got a couple issues. Can you help us out? If we can get these issues resolved, then we can do this new program for your new property, get you leased up and going. And it worked like magic. It was fantastic. And that's where I think the ideal of sales and credit working together, and even customer service and marketing, is when you are all in the same place and you're helping everyone get what they need. It's life-changing. It really is a lot of fun.
I worked with a client, a technology firm really that had a technology and outsourcing firm, and they actually provided that type of information of the red, yellow, green customers. And the sales force after time learned to appreciate it. And they realized that they could increase their sales by concentrating on the greens.
Exactly.
And lo and behold, they started avoiding the reds like they were the plague.
Yeah.
And it was positive for everybody. Positive impact on sales profits and cash flow and reduction of DSO. It was all wonderful results. The one thing I did early on in my career is I used to go out with the salesman on the sales calls. And so I was just tagging along on the sales calls. If anything came up, would ask the customer if they have any issues in terms of billing and their statement and whatever like that, but it wasn't primarily a collection call. But I went along with sales and learned just a tremendous amount from them. But at the same time, we talked about each of the customers. And so the salespeople gained a greater appreciation for what credit was trying to do and putting up with the customers. I know Bob loves the customer visit. It's a real valuable way to build that relationship. Andrea or Kelly, anything you can add?
Looks like they're having a hard time getting back in. So for some reason
I thought they were back in.
Yeah, they got blocked out for some reason. I don't know what happened. Maybe their sales managers called up. I don't know.
So
the only thing I would add, I would compliment what you've said, because these are great things, but set up a mechanism where you can do a pre-check before somebody goes to an account. Just give them a cursory, red light, green light, so that they know. Meet with them, do ride-alongs with the salespeople. Dave, that's spot on in my view. Attend their sales team meetings, listen to what they're talking about, maybe make a very brief presentation on something meaningful to them. The two-way communication builds trust, and that's what you're looking for. They are your eyes and ears. And then if you want to motivate them, and people are generally coin operated, so you need to motivate them, and they're also very, very competitive. One of the things I used to do that was pretty effective, I mean, I had good rapport with the salespeople, but I would compare sales teams, in terms of our metrics, their teams, DSO, average days past due, whatever it would be, and I would stack rank them, and let the whole sales department see how each team compared with one another. And I mean, that's not along the lines of exactly developing teamwork, but what it did is it developed a common purpose, because they're very competitive. They don't want to be the fourth ranking sales team in the company. They don't want to do that. They're very competitive people. So, just building trust, doing things to motivate them from their point of view, I think are excellent.
And attending the sales meetings is extremely important, especially if they're doing any sort of new launch or anything new. You need to be there to know what they're doing.
Absolutely.
You don't want it to hit credit after the fact.
I had a situation
and credit gets overlooked. And I agree with you. You should get get some time on their schedule, which is I used to do, for a short presentation, 15, 20 minutes on a topic that they like. It always went over well when I did that, and I learned so much about what they were doing by being there, and then they start continuing a part of the team. It's that by associating with them more, you seem to be more part of the team.
No surprises. That's the other thing. No surprises. I had a situation one time. I was thrown into the fire. My boss called me. He says, "You're now taking on credit for this business segment I wasn't involved in at the time." And guess what? All their salespeople are coming in for a national sales meeting, and they're really angry at the credit department. So I went in,
Wow.
and it's in 2 days. So I went in there. I didn't know I didn't understand their business very well. I didn't know anybody. I went and I said, "Look, here's the deal. No surprises. Not going to be any surprises. We're going to let you know when we're putting people on hold. We're going to let you know when they're off. We're going to let you know in advance if we're going to approve or not approve." I said, "We're going to have a credit policy that's going to be fair. It's going to be predictable for you because we're going to be consistent. And therefore, when you go into an account, you're going to know, oh, these situations I'm seeing, guess what? I need to behave this way because my credit department is going to react in a predictable fashion." So anyway, Dave, we're running overtime.
Well, it's time to end, Bob. So I think we've answered all the questions. We've told a lot of stories. If you haven't already, your opinion matters. We'd like you to take this brief survey and rate it. Also, here's the code for the early bird discount on the mini certifications. And the next session is Hands on Deck, a SWAT team approach to managing financial risk. And that's at noon Central tomorrow. And you're back on that, aren't you, Bob?
Yes, I am.
Okay, so if you want to hear more stories from Bob, hopefully you won't tell the same ones. Join us. It's great to work with you, Bob and Michelle. Thank you, Andrea and Kelly. We're sorry that there were technical difficulties there, but thank you for your input. And again, to the audience, thank you for listening in. We trust it's been informative. And again, our apologies for the technical difficulties. And so that's it. This is Dave Schmidt for Credit Today, signing off. Thank you for attending the Credit Captains Conference 2022. Bye now.
Thanks so much. Take care.
Bye-bye.